Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I'll be taking you through how to account for capital grant, which is under IAS 20. Now, let's look at the question. The requirement says show how the grant will be accounted for. Let's see. ABC acquired a telecommunication equipment at a cost of 100 million for the purpose of extending its network coverage to remote areas of the country which prior to the acquisition had no telecommunication network service provider. The government has made available a grant of 20 million for ABC for the acquisition, provided the network operation lasts in these areas for at least 5 years. ABC intends to depreciate the equipment over 15 years. So again, before the recognition, the entity have to be certain that they will meet the requirement. So if there is indication that they will depreciate the asset over 15 years, ideally, that would mean that the asset will last beyond 5 years or will last for 5 years. Now, how do we account for the capital grant? The entity can choose one of two ways. So, one can treat it as a deferred grant, or two, use the grant to reduce the cost. So we say use grant to reduce cost or carrying amount. Of assets. So I'll be showing you the two ways of accounting for the grant. Now, starting with deferred grant. Now, the deferred grant at the initial measurement, or call it initial recognition. This is what the entity will pass as double entry. When the grant is received, debit, bank, or cash, which is 20 million, and they will credit deferred grant. Now, what it means is that at year end, they will release the grant over the period the asset will be used. So note that if the asset will be depreciated on a straight line basis, the straight line basis will be used to release the grant. If the reducing balance is going to be used for the asset, the entity have to use the reducing balance to release the grant. Now, at the year end, the following have to be noted. In P&L, there will be depreciation on assets, and that depreciation will be the asset value 100 divided by 15, because here it has no residual value, so it will be 100 over 15. So let's see, 100 divided by 15, that's 6.67 million. Then we look at the grant released to P&L, and that would be the 20 divided by 15. So 20 divided by 15, that is 1.33 million. So we realize that this will go to P&L. Now, where the depreciation of the asset is, so if this depreciation is in cost of sales, this grant will be credited to cost of sales. However, the entity can also consider it as other income. Now, the grant balance would be 20 minus the first release, which is 1.33. So 20 minus 1.33, that gives us 18.67, and this have to be classified into current, which is the next payment or release, and this will be current liability. Take note of that. And the balance, which is 18.67 minus 1.33, which is 17.34, this will be non-current liability. Remember, it will be in the name of, all of these will be in the name of this, and this would be in the name of deferred grant, or call it income. Now, quickly, let's look at the second approach. Now, if the entity so chooses to account for the grant, so let me quickly have it here. That is reduction. They use it to reduce the cost, reduction to cost, or carrying amount. It means that at the initial measurement, please take note, initial measurement, the double entry they will pass will be, they will debit cash or bank, that is if the grant is received, and they will credit the asset. So they will credit the asset. So here 20. So you see that the carrying amount after the reduction would be 100 minus 20, and that should give us 80 million. So at year end, please take note, it means that in P&L, this is what you will see. The depreciation will now be based on 80, not 100, because we have used the grant to reduce the asset value. So it will be 80 divided by 15. So here you have 5.33 million as the charge to P&L. So again, if this goes to cost of sales, that is where you will find it as the depreciation on the asset. Or if it is part of operating, expenses, you would find it as part of the operating expenses. Now, notice here that if you take the 5.33 and you come back to look at the net impact that the first treatment will have in P&L, is to say that we have, so impact, the impact of these two values in P&L, the impact is to say that this is cost 6.67 minus 1.33, and that should give us approximately 5.34. So let's see, 6.67 minus 1.33, so 5.34, and this impact in P&L is the same as the depreciation you will find here, and that is how we account for capital grant. So the net impact, whichever approach or whichever basis or method the entity want to adopt, the impact in P&L to be the same. However, if they use the deferred grant method or approach, they will have a liability on their books. But if they use the reduction to cost, there will be no liability to show because the grant balance is nil. There's no balance on the grant. The grant was used to what? Reduce the asset cost. Great. I hope this helps you in your preparation for the FR exam and has helped you to understand how we account for capital grant. Please subscribe to this channel to receive updates on new videos.